Hey, welcome back to today's installment of the ABCs of mortgage. Today we're on letter P, and I've got two different P's. The first one would be points. You might hear this term when you're getting ready to lock in your interest rate. Your loan officer might bring up that you can do this rate with no points or this rate with 1 point, different things like that. And what a point is 1 percentage point of your loan amount. So for example, if your loan amount's $100,000, 1 point is 1% of $100,000, which is $1,000. And what the point actually is prepaid interest. So what you're doing is you're paying a certain amount of interest up front so that you can get a lower interest rate. That's kind of like called buying the interest rate down. So for example, I'm just throwing this out there. Today the rate might be 3 1/4 with no points. Or you might be able to do a 3% with 1 point. So you're exchanging some prepaid interest for a lower rate over the term of your loan. Sometimes it's wise to do the points, sometimes it's not. It changes every day. Sometimes it's easier to buy down further with 1 point, and sometimes it's just not worth it. So always check with your lender to see if it's something that you should be doing. The next P we're going to talk about is PMI, which stands for private mortgage insurance. What this is, and it's depending on the loan type, this is the protection that the lender has against the borrower defaulting on their mortgage. So lenders do require this on many loan types, especially if there is not 20% down payment, because what would happen if the lender takes the loan to foreclosure and they have to sell it for like less than what it's worth, then the private mortgage insurance picks up a coverage amount that basically reimburses the lender or covers the loss for the lender. There's different levels of PMI, and the PMI costs different for every borrower and every loan type. So it's kind of like any other insurance premium. Your lender is going to want to shop for that to get you the lowest possible rate, or try to find a loan program that avoids PMI altogether for you. There's so many different options and types of PMI that you always want to ask your lender if there's any way to get out of it, number one. And number two, are there any cheaper options for PMI, or is it a standard fixed policy? Thank you. So